Hi everyone, thanks for watching. Today we will be talking about Beyond Meat and whether it's a stock you should buy or not buy. Here's a plan for today. I'll start with a quick introduction of our team and the company's background. Then we'll go over the industry, look at Beyond Meat situation, and finally give our recommendations. My name is Abigail Sanchez, and I'll be starting off the presentation. I'm joined by Zach, who will cover the financial analysis, and Hinda, who will discuss the recommendations. Now that you met the team, let's jump into the executive summary of Beyond Meat. Beyond Meat was founded in 2009 by Ethan Brown, and it's headquartered in El Segundo, California. The company makes plant based meat substitutes designed to look, cook, and taste like real meat. Their products include burgers, sausages, chicken tenders, and beef crumbles. You can find Beyond Meat in grocery stores like Walmart and Costco, as well as in restaurants such as McDonald's, Dunkin', and Starbucks. That shows the global reach the brand has built over the past decade. The company's mission is to feed a better future, but by that, they mean creating food that's healthier, more sustainable for the planet, and better for animal welfare. Beyond Meat positions itself not just as a food company, but as part of the movement to change the way the world eats. The plant based protein industry has been growing rapidly in recent years. Several forces are driving this growth. First, health. Many consumers are trying to reduce cholesterol, eat fewer saturated fats, and move away from red meat. Second, climate change and sustainability. Producing beef requires large amounts of water and land and contributes to greenhouse gas emission. Plant based proteins have a much smaller environmental footprint. Third, animal welfare. With increased awareness about factory farming, more people are looking for alternatives that align with their values. Finally, changing lifestyles. It's not just vegans and vegetarians driving this trend. Flexitarians or people who still eat meat but want to cut back are the majority of Beyond Meat's target customers. Of course, Beyond Meat is not alone. Impossible Foods is a direct competitor, especially in fast food with the Impossible Whopper. Big companies like Nestle, Tyson, and Kellogg's are also entering the market with their own products. So while the industry is expanding, competition is very fierce. Beyond Meat is seen as a pioneer in the plant based industry. At one point, it was one of the hottest IPOs in the market with its stock price soaring in 2019. But since then, the company has struggled. Sales growth has slowed, profitability remains a challenge, and the stock price has dropped significantly. The key question for investors is whether to buy the stock now and hope for a rebound or to stay away. After analyzing the company, our stance is don't buy. We believe the risk, including slowing growth, intense competition, and financial instability, outweigh the rewards. To explain why, we'll look at two frameworks: Pastel analysis and Porter's five forces. Let's start with Pastel, which looks at the external environment. Political food labeling laws are a challenge. In some states, there has been pushback on whether plant based products can use terms like meat or burger. Trade tariffs and international regulations also raise costs. Economic raw materials costs, especially pea protein, have increased. Inflation makes Beyond Meat products more expensive compared to regular beef. Since they are already priced at a premium, many consumers hesitate to buy them regularly. Social, younger consumers are more open to plant based diets, but a large portions of people still prefer traditional meat. Many Many also see plant based meat as too processed or unnatural. Technological Beyond Meat spends heavily on research and development to improve taste and texture. While this innovation is necessary to compete, it is very costly and has not yet resulted in consistent profits. Environmental Beyond Meat promotes itself as eco friendly. Plant based proteins use less water and land than livestock, but the production process still has environmental footprint, especially in packaging and processing. Legal, like any food company, Beyond Meat faces risk around lawsuits and food safety compliance. If they exaggerate health benefits, they can be challenged legally. So overall, Pesto shows a mixed opportunities and risk with many external challenges. Now let's look at Porter's five forces. The threat of new entrants is high because both startups and major food corporations are moving into the plant based market. Buyer power is strong since consumers can easily switch to competitors to go back to traditional meats. Supplier power is also an issue. There are limited suppliers for key ingredients like pea protein, which gives them leverage over Beyond Meat. The threat of substitute is high. Traditional meat or other plant based proteins and lab grown meat all compete directly. Finally, rivalry among competitors is intense. Beyond Meat faces pressure from Impossible Foods, Nestle, Tyson, and many other brands. This competition drives down prices and squeezes profitability. Overall, Porter's five forces show that Beyond Meat is in a very tough competitive environment. Putting it all together, Beyond Meat was a pioneer in the plant-based movement, but today it faces rising costs, strong competition, and declining investor confidence. That is why our group position is don't buy. With that, I'll hand it over to Zach, who will take us deeper into financial analysis of Beyond Meat.
Today, I'll be walking you through our internal analysis of Beyond Meat. We'll be covering four main ideas. It'll be the SWOT analysis, financial overview, leadership and culture, and efficiency of operations. Firstly, we'll be going over the SWOT analysis. Starting with the strength, they have a very powerful brand recognition. They're one of the first mover names in the plant-based category. They have an established retail distribution. They have a large presence in major grocery chains worldwide. They're proprietary formulation IP, meaning that they own all their recipes and production processes. Some of their weaknesses are they have a fundamentally broken model. They have negative gross margins and an unsustainable cash burn. They have a rapidly eroding brand equity, which means their discounting their discounting have trained consumers to avoid the full price. Their leadership and strategic instability, meaning that their high executive turnover and layoffs signal deep distress. Some opportunities is international market growth, meaning that they require massive capital that they don't have. Their shift to health and sustainability. The consumer trend is now towards less processed foods, which hurts Beyond Meat because they are technically a processed food. Some threats are an intense, well-funded competition, such as Tyson, Kellogg's, and private labels. They have macroeconomic pressure. Inflation squeezes discretionary spending on premium foods. Next, we'll be looking at the financials. So as we can see, they've had revenue collapse. They're down 22% year-over-year growth, meaning that the demand is disappearing, not growing, which is never good for a business. They have catastrophic margins. Their gross margin is minus 5.6% in the first quarter of 2024, meaning that they're losing money on every single product sold. They have unsustainable burn rate. Their net loss is negative 54.4 million. And that was last quarter, basically meaning that they're burning cash with no path to profitability. The market verdict is their share price went from $130, and that was at the 2021 peak, to $7.50, which is today's value, which is pretty bad. This is a minus 94% destruction of shareholder value. Next, we'll be looking at leadership and culture. As we can see, the executive team ignored clear warning signs and failed to adjust the core business strategy in time. The talent instability, high-profile departures of the CFO and COO alongside major layoffs points to a crisis of confidence and a lack of a clear plan. The founder's curse. Founder CEO Ethan Brown's deep attachment to the original vision is now a major barrier to the radical restructuring needed for survival. This is all on the leadership side. For the culture, they have a growth at all costs mindset. The initial startup culture failed to evolve into one focused on profitability and operational discipline. Their resistance to market reality. Internal culture was slow to acknowledge the consumer shift away from highly processed premium foods. Their brand identity crisis. Employee and internal focus remains on a premium mission that the market no longer values, creating strategic inertia. And lastly, we'll just be talking about efficiency of operations. So they have a negative contribution margin, as we've talked about earlier. Every product that they sell actively increases the company's total losses. Their chronic overcapacity, high fixed costs from factories and equipment that are significantly underutilized, their inefficient scale, increased production volume has failed to deliver the promised reduction in per unit costs. And then lastly, their broken supply leverage, their lack of purchasing power to secure affordable raw materials despite their company size really just doesn't give them a lot of opportunity to grow and become a better company.
Why buy? Some people might say Beyond Meat is a good buy. More young people in flexitarian are choosing plant-based food, so demand is going up. Beyond Meat has a strong brand that people recognize in stores and restaurants. They also partner with big fast food chains and global retails, which help them reach more customers. The the company keeps making new product, showing it can innovate. The whole plant based industry is expected to grow a lot in the future, plus, more people are thinking about health and the environment, which support Beyond Meat's mission. For these reasons, some believe the company has long term growth potential, even if stocks is risk right now. Why don't buy? On the other hand, the reasons not to buy are very strong. Beyond Meat is losing money on every product it sells because its gross, gross margin is negative. Last year, sales dropped by 22%, which means if they sold 100 items before, now they're only selling 78. In just one quarter, the company lost 54 million, which shows it's burning cash very fast. The brand has also weakened because the customer now expect discount and don't want to pay full prices. Leadership change keep happening, which create instability. And finally, a huge competitors like Tyson, Nestle, and Impossible Foods have more money and resources to win in this market. Altogether, the risks are much greater than the benefit. Comparing buy and don't buy. When we compare the two sides, the buy argument focuses on the long-term growth of the industry and Beyond Meat's strong brand, but they don't. But the don't buy argument points to serious problem happening right now, which is like falling sales, negative margins, big competitors taking over the market share. The math shows the risk is too high. A 94% drop in share prices from $130 to only 7.50 means investors have lost almost all their value. So even though the industry is growing, Beyond Me is not the company to bet on. Our strategic recommendation is don't buy. Beyond Meat helped start the plant-based food movement, but today the company is in trouble. Sales are shrinking, profits are negative, and the company is losing tens of millions of dollars every quarter. With so many risks and stronger competitors in the market, it is not safe to invest. The smart choice right now is to stay away from the stocks. In conclusion, Beyond Meat is important to the plant based industry, but its business model is broken. The number shows a steady decline in sales, huge losses. While the overall market for plant based protein is expected to grow, Beyond Meat does not have the financial strength to take advantage of it. That is why our final recommendation is simple: don't buy. Thank you for listening.